Manias, Panics, and Crashes, A History of Financial Crises, written by Charles Kindleberger and Robert Aliber, summarized by Detailed Book Summaries. Don't forget to subscribe. Chapter 1. Financial Crisis, a Hardy Perennial. Imagine you're walking through a bustling city square. The sun is shining, people are chatting, cafes are open, and life is good. Suddenly, without warning, the mood shifts. The chatter grows tense, people are checking their phones nervously, and shopkeepers are closing their doors. What happened? This kind of sudden turn from confidence to chaos is exactly what Charles Kindleberger explores in the opening chapter of Manias, Panics, and Crashes. Right from the start, he frames financial crises not as rare anomalies, but as recurring features of economic life. Like seasonal storms, they come and go, sometimes with devastating intensity, but they are always part of the landscape. Kindleberger opens by challenging a comforting myth, that with enough regulation, innovation, and insight, we can eliminate financial crises. The truth, he argues, is far less reassuring. Crises are hardy perennials. They crop up repeatedly across time and geography, shaped by different instruments, actors, and policies, but always following a similar emotional and economic arc. So why do we keep falling into the same trap? Kindleberger suggests that it's not just flawed systems or bad policies that cause crises. It's us, human beings, with our emotions, ambitions, and cognitive biases. Financial manias and panics aren't just numbers on a screen or lines on a chart. They're psychological events. We believe we've found the next big thing. We pile in. We convince others to do the same. And before long, we've created a bubble that's too fragile to last. One of the most compelling parts of this chapter is Kindleberger's historical scope. He walks us through financial turmoil not just in the modern world but stretching back centuries, from the South Sea bubble of 1720 to the speculative excesses of the late 20th century. Each example reinforces a central idea. While the details differ, the structure remains consistent. He also introduces the idea that crises often follow a displacement, an external shock or innovation that creates new opportunities. It could be the opening of a new market, a major technological breakthrough, or the deregulation of a financial sector. These shifts attract investment initially for good reason. But as enthusiasm builds, rational investing gives way to speculation. Prices rise not because of value but because of momentum. And soon we've entered the mania stage. The tone of the chapter is both analytical and quietly urgent. Kindleberger doesn't preach. He explains. He wants us to see the patterns, not just so we can admire their historical elegance, but so we can recognize them when they start to form around us. He brings in the metaphor of economic memory. Just as people forget wars and repeat the same diplomatic mistakes, we forget financial disasters and make the same speculative errors. The result is a kind of collective amnesia that leaves us vulnerable to the same cycles again and again. But here's the twist. Kindleberger also tells us that while crises may be inevitable, their severity isn't. The way societies respond to the early signs of overheating, the tools they use to contain panic, and the presence or absence of a lender of last resort all influence whether a financial disturbance becomes a full-blown catastrophe. This sets the stage for the rest of the book. Kindleberger is laying out not just a chronology of crises, but a framework, a psychological and structural template for how manias, panics, and crashes unfold. Before moving on, he leaves us with a question. If financial crises are so common, why do we keep acting like each one is a surprise? The implication is sobering. Maybe we don't want to remember. Maybe the allure of easy profit is too strong. Or maybe our systems are built to encourage risk-taking right up to the edge of disaster. Either way, Kindleberger's message is clear. If we want to understand economic history, or protect ourselves from future ruin, we need to understand financial crises. Not as freak accidents, but as deeply human phenomena that repeat with eerie regularity. And with that, we're invited into a deeper exploration. One that will take us through the anatomy of bubbles, the psychology of crowds, the mechanics of contagion, and the high-stakes role of government intervention. Chapter 2. The Anatomy of a Typical Crisis. Have you ever watched someone stack dominoes, carefully, precisely placing each tile just close enough to tip the next? It's a delicate process, mesmerizing in its balance. But beneath the beauty lies inevitability. One nudge, one slight disruption, and the entire line collapses. This is the image Charles Kindleberger evokes in Chapter 2 of Manias, Panics, and Crashes, where he dissects the anatomy of a typical financial crisis. Crises, he suggests, don't erupt out of nowhere. They follow a recognizable pattern, a rhythm of rising optimism, reckless speculation, abrupt panic, and painful correction. It is not a rigid script, but it's familiar enough to feel eerily consistent across time and place. Kindleberger lays out 5 essential stages in this anatomy: displacement, boom, euphoria, crisis, and revulsion or panic. Each stage builds on the last, much like a line of dominoes. What begins as grounded enthusiasm morphs into hysteria, and finally collapse. These aren't just shifts in market metrics, they're shifts in human psychology, in collective sentiment, in trust. It all begins with displacement, a shock to the system. But this shock isn't necessarily a negative one. Often it's something exciting. A new technology, a financial innovation, or a major geopolitical shift that opens new economic frontiers. It's a spark. In the beginning, investors are rational, assessing genuine opportunities with cautious optimism. But as more players enter the game, the narrative moves away from fundamentals and becomes driven by momentum. Prices rise not because they should, but because they are. That leads us into the boom. Optimism begins to compound. Banks loosen their lending standards. Credit flows freely. People borrow to invest and asset prices surge. The financial and media ecosystems begin to echo with confidence. Terms like "this time it's different" start to gain traction, as conventional wisdom gives way to excitement and FOMO, the fear of missing out. While this stage hasn't tipped into mania yet, the boundaries are blurring. Inevitably, the market crosses into euphoria. Here, speculation becomes unhinged from reality. Investors stop evaluating the true worth of assets. They chase trends, not value. The crowd becomes the compass. Fortunes are made overnight. And fraud, always lurking in the shadows of fast money, begins to flourish. In euphoric markets, scrutiny is unwelcome. No one wants to question the golden goose. But the structure beneath the optimism is fragile. Leverage is high, expectations are skybound, and the gap between price and reality has never been wider. Then comes the crisis, the turn. Sometimes it's triggered by a single event, a major default, a rise in interest rates, or the simple realization that prices can't rise forever. Confidence cracks. Selling begins. Those who borrowed heavily to ride the wave now face losses they can't absorb. Panic sets in, and the market's self-destructive feedback loop begins. Liquidity evaporates. Lenders retreat. Asset values plummet. What follows is revulsion or sheer panic. The same assets that were so feverishly pursued are now radioactive. Trust disintegrates. Financial institutions that once seemed invincible falter or collapse. The system, now drained of confidence and capital, grinds to a halt. At this stage, governments and central banks are left with unenviable choices: intervene and risk encouraging future recklessness, moral hazard, or stand back and risk total systemic failure. It's a dilemma Kindleberger promises to explore in later chapters, particularly in his discussion of the lender of last resort. What makes this 5-stage model so compelling is its versatility. Kindleberger applies it across centuries, continents, and asset classes. Whether it's tulip mania in 17th century Holland, the South Sea bubble, the 1929 stock market crash, or the dot-com bust of the late 1990s, the pattern holds. It's not a fortune teller's crystal ball, but it is a lens, one that helps us see past the surface chaos to the deeper structure of these recurring events. Ultimately, Chapter 2 doesn't just teach us how markets behave in times of turmoil, it teaches us how we behave. Kindleberger isn't simply analyzing numbers. He's exploring psychology. The anatomy of a financial crisis, as he reveals, is less about spreadsheets and more about human nature. Our capacity for hope, our tendency toward greed, our susceptibility to fear, and our near irresistible urge to follow the crowd. In that reflection, we don't just see markets, we see ourselves. And in seeing, perhaps we begin to understand. Chapter 3, Speculative Manias. Why do we buy things we know are overpriced? Why do smart, rational people ignore the warning signs and leap headfirst into obvious traps? Why do we convince ourselves that, just this once, the laws of financial gravity don't apply? In Chapter 3 of Manias, Panics, and Crashes, Charles Kindleberger explores these questions by diving deep into the world of speculative manias, those exhilarating, irrational, and often catastrophic surges of excitement that sweep through markets, inflate asset prices, and leave devastation in their wake. This chapter isn't just about charts and economic theories. It's a study in human emotion. It's about how we behave when we think we've stumbled upon a golden ticket, and why, time and again, entire societies suspend their skepticism in the grip of euphoric belief. Right from the start, Kindleberger makes an essential point. Manias are not rational events. They are emotional stampedes. They begin with a spark, an innovation, a sudden financial success, or a breakthrough investment that captures public imagination. The story spreads. It makes headlines. Friends talk. Neighbors boast. And before long you feel it, that creeping anxiety that you might be missing out. This is the emotional engine of a mania. FOMO, the fear of missing out. It drives people to invest without thinking, to chase rising prices without understanding the risks. As the frenzy grows, even the most cautious among us feel the pressure to join in. And as Kindleberger emphasizes, this irrationality isn't limited to the uninformed or inexperienced. In fact, it's often the seasoned investors, the bankers, and the finance veterans, people who should know better, who get swept up in the tide. Intelligence, Kindleberger argues, doesn't make people immune to manias. It just gives them better tools to rationalize their behavior. To illustrate the power and persistence of speculative manias, Kindleberger takes us on a historical tour of some of the most infamous examples. We visit 17th century Holland, where tulip bulbs once traded for the price of a house. We explore the Mississippi bubble and the South Sea bubble of the 18th century, both fueled by grand promises of overseas riches. We watch railway mania grip 1840s Britain, where investors believed train tracks would guarantee endless wealth. And closer to our own time, we witness the dizzying highs of the dot-com bubble, where internet startups with no profits were valued in the billions. Each of these episodes had its own seductive story, what Kindleberger calls the New Era Syndrome. There is always a belief that the old rules no longer apply. Technology, globalization, deregulation, something we are told has fundamentally changed. And for a while it seems true. Prices climb. Speculators feel brilliant. The story feeds the market, and the market in turn feeds the story. Here, Kindleberger introduces a powerful concept: reflexivity. The idea is simple but profound. As more people invest, prices rise. Rising prices attract more investors. The process becomes self-reinforcing, a loop of confidence and capital. Everyone wants in, and no one wants to be the first to step out. This is the dark magic of a mania. It sustains itself. It floats on momentum and belief, detached from underlying value, until something breaks. But what truly fuels this irrational momentum isn't just greed. It's imitation. Kindleberger argues that herd behavior lies at the heart of every speculative bubble. People imitate others, especially when those others seem to be making money. In the heat of a mania, skepticism is punished. The rational investor becomes a joke. The cautious analyst is drowned out. If you warn people, you're labeled a pessimist. If you sell early, you're ridiculed. Only when the collapse comes do people look back and wish they'd paid attention. This chapter reads as much like a study in psychology as it does a financial analysis. Kindleberger compares manias to social epidemics, contagious, fast-moving, and immune to reason. People buy not because something is fundamentally valuable, but because everyone else is buying. The fear of missing out eclipses the fear of losing everything. And lurking just beneath this frenzy are the opportunists, the fraudsters, the swindlers, the salesmen of dreams. Kindleberger notes that speculative manias create fertile ground for scams, because people stop asking questions when they're busy making money. Due diligence vanishes. Hope takes the wheel and reason is left behind. Eventually, though, every mania hits a wall. That wall is usually made of credit. Credit is the oxygen that keeps speculation alive. As long as banks are lending and investors can borrow, the fire burns. But when lenders grow cautious, or borrowers reach their limit, the music slows. Somewhere someone sells. Others follow. Doubt enters the conversation. And then, almost imperceptibly at first, the mania transforms into a crisis. Kindleberger doesn't take us all the way into the crash in this chapter. Not yet. For now, his focus is on understanding the mania itself, not as an outlier but as a recurring pattern of human behavior. Speculative manias, he argues, are not flukes. They are inevitable as long as people remain people, emotional, imitative, easily seduced by stories of easy wealth. The real danger lies in forgetting that. The key takeaway from Chapter 3 is clear. Speculative manias are not the exception, they are the rule. Until we learn to recognize the signs, to resist the pull of the crowd, and to challenge the comforting narratives of a new era, we will continue to repeat the cycle. So the next time you hear someone say, "This time it's different," pause. Ask questions. Think twice. Because the next chapter in that story rarely ends with endless profits. More often it's called the crash. Chapter 4. Fueling the flames, the expansion of credit. Have you ever tried to build a fire? It begins with a spark, then some dry twigs, maybe a handful of leaves. But the moment you douse it with lighter fluid, everything changes. The flames leap, the heat surges, and the fire roars to life. In the financial world, that lighter fluid is credit. And in Chapter 4 of Manias, Panics, and Crashes, Charles Kindleberger takes us into the engine room of financial crises, credit expansion. While speculative manias may provide the spark, it is the easy, unchecked availability of credit that turns market excitement into full-blown inferno. Manias, as we've seen, are powered by psychology, by optimism, by the stories we tell ourselves, by the contagious excitement of rising prices. But emotion and momentum alone can only carry a bubble so far. To reach mania levels, to stretch into absurd valuations and systemic risk, you need fuel. And that fuel almost always comes in the form of borrowed money, cheap, abundant, and dangerously easy to access. Kindleberger opens the chapter with a warning. Credit is not inherently bad. On the contrary, it's a powerful economic tool. Properly used, it finances productive investments, supports innovation, and fuels sustainable growth. But misused, especially during periods of speculative enthusiasm, it becomes toxic. Credit is a double-edged sword. In boom times, it feels like a gift. But when the cycle turns, it becomes the instrument of destruction. So how does this process of overexpansion begin? Often it starts with monetary easing. Central banks, responding to economic slowdowns or policy objectives, lower interest rates to stimulate growth. Suddenly money becomes cheaper. Liquidity pours into the system. Investors, now flush with cash, begin chasing higher returns. Lenders, eager to deploy capital and reap profits, start relaxing their standards. Borrowers take on more debt. Asset prices begin to rise. Not because of improved fundamentals, but because there's more money chasing the same assets. This is the moment when the financial system starts shedding its guardrails. Kindleberger offers numerous historical examples of how banks, non-bank lenders, and even governments have contributed to these dangerous buildups. Sometimes the expansion of credit is the result of intentional policy decisions. Other times it arises from financial innovation, deregulation, or simply the herd instincts of competitive lending markets. Regardless of the cause, the effect is the same: more debt flowing to more people, chasing the illusion of endless appreciation. What makes this process particularly insidious is that it feeds on itself. As asset prices climb, the value of collateral increases. That makes borrowers appear more creditworthy. Lenders, seeing stronger collateral, become even more willing to lend. Borrowers respond by taking on even more debt. Prices rise further. And so the cycle continues. Credit and asset prices locked in a dangerous upward spiral. But with every turn of that cycle, the system becomes more fragile. Because debt magnifies risk. It inflates the upside, but it also amplifies the fall. When asset prices inevitably turn downward, the same borrowers who once looked secure suddenly appear overleveraged. Their collateral shrinks. Margin calls go out. Defaults begin to rise. And the same financial institutions that once handed out credit freely now slam the doors shut. Kindleberger emphasizes the special risk posed by leveraged speculation, that is, investing with borrowed money. In such cases, even a modest drop in asset value can erase a speculator's equity, triggering forced selling. That selling depresses prices further, which prompts more margin calls, more selling, and a vicious cycle of falling prices and collapsing confidence. In the worst moments, the system doesn't just wobble, it collapses like a house of cards. Beyond the individual decisions of lenders and borrowers, Kindleberger points to deeper structural vulnerabilities. Modern financial systems, he argues, are inherently prone to credit overexpansion. In a competitive environment, no lender wants to be the first to tighten standards and lose market share. Regulatory oversight often lags behind the pace of innovation, and political leaders more focused on short-term growth than long-term stability may resist efforts to cool overheated markets. Kindleberger also warns of the global dimension of credit cycles. In today's interconnected world, capital knows no borders. An expansionary policy in one major economy, such as the United States, can unleash waves of liquidity into emerging markets, fueling bubbles far from the original source. But when conditions tighten, the reversal is just as swift and brutal. The flood of capital becomes a sudden, destabilizing outflow. Throughout the chapter, Kindleberger is careful not to vilify credit itself. He understands its vital role in a functioning economy, but he insists that credit must be handled with care, especially in times of exuberance. Left unchecked, it doesn't just support bubbles. It inflates them past the point of no return. His final insight is stark and sobering. The most devastating financial crises are rarely the result of too little credit, but rather too much extended too easily to too many people, chasing too few sound investments. Time and again we forget this. Time and again we are seduced by the promise of easy money. And time and again we pay the price, usually after it's far too late to stop the flames from consuming everything they touch. Chapter 5. The Emergence of Swindles. What happens when everyone's making money and no one's asking questions? Who checks the locks when the whole town's at the party? In Chapter 5 of Manias, Panics, and Crashes, Charles Kindleberger leads us into one of the darker, yet inevitable corners of financial manias: fraud. While bubbles are building and asset prices are soaring, something else quietly grows beneath the surface: deception. Kindleberger's argument is clear and blunt. Swindles aren't just occasional blemishes in the story of speculation. They are structural features of manias. When speculation takes off, so does fraud. He writes that swindles are a response to the opportunities provided by manias. In other words, when the system becomes saturated with easy money and unchecked optimism, conditions become ripe for dishonesty to thrive. It's not simply that fraud is more tempting. It's that the very nature of a mania lowers the defenses that would normally keep fraud at bay. Due diligence declines. Risk assessments turn complacent. People stop asking hard questions, not because they're fooled but because they're too eager to believe. This is when the con artist steps in. Kindleberger doesn't frame this solely in moral terms. He's not just pointing fingers at the unethical few. He sees swindles as systemic indicators, recurring with remarkable consistency in nearly every major speculative cycle. They are like fever spikes in a patient, signs that the financial system is overheating. And just like fever, they often go ignored until it's too late. What makes this stage particularly dangerous is that fraud during a boom is often hidden in plain sight. The environment is soaked in confidence. Returns are high, stories sound plausible, and no one wants to be the killjoy. The more successful a scam appears, the more people it attracts. The logic becomes circular. If so many others are getting paid, then it must be real. One of the most infamous examples Kindleberger invokes is Charles Ponzi, whose 1920 scheme promised incredible returns from arbitrage and postal coupons. On its face, it didn't make sense. But once people started seeing payouts, the doubts vanished. Reality was overridden by belief, and belief in a mania can become bulletproof. Kindleberger shows how manias create their own form of blind trust. As the system grows and prices surge, even the absurd begins to seem reasonable. Anything can be rationalized in the glow of rising fortunes. It's only when the bubble bursts, when the tide goes out, that the truth is revealed. Or, as Warren Buffett would later put it more succinctly, only when the tide goes out do you discover who's been swimming naked. Another key insight in this chapter is Kindleberger's exploration of moral hazard, the dangerous assumption that someone else will clean up the mess. When investors, institutions, or even governments believe that a bailout will come, that central banks will step in, or that regulators will look the other way, the incentives for honesty erode. The result is not just individual fraudsters, but systemic deception. Entire institutions begin misrepresenting risks, dressing up bad loans, or manipulating earnings. These aren't isolated schemes, they're corporate or structural cons, with far more devastating consequences when exposed. Eventually, the house of cards collapses. The market turns. Withdrawals surge. And what was once a golden opportunity becomes a scandal. Headlines shift from celebration to investigation. Lawsuits fly. The public's trust, so blindly given in the boom, is shattered. One of Kindleberger's sharpest observations is that the emergence of swindles is not just a consequence of bubbles. It's a signal. Fraud isn't just collateral damage. It's a red flag that the bubble may be nearing its peak. When stories of embezzlement, fabricated profits, or too good to be true returns start making the rounds, it's often a sign that belief has overtaken reason, and the market is teetering. These scandals are the canaries in the coal mine. But here's the catch. By the time we see the canaries drop, it's often already too late. Ultimately, Kindleberger doesn't treat fraud as an aberration. He treats it as an inevitable phase in the cycle, especially during euphoria. When speculation soars, scrutiny plummets. The world becomes a believer. And there will always be those waiting to exploit that belief. So what's the lesson? Stay alert, especially when everyone else is celebrating. Ask questions. Check the numbers. Be skeptical of meteoric returns that no one seems to understand. Kindleberger urges us to remember that in every boom, behind the curtain of optimism and upward trends, someone is running a con. And when the curtain falls, it's not just the speculators who suffer. It's the savers, the long-term investors, the institutions, and ordinary people who trusted too much and asked too late. Chapter 6. The Critical Stage. Picture a crowded theater packed with excited investors, all enthralled by the dazzling performance unfolding on stage. The music is soaring, the actors radiant, and no one wants to leave. Then, barely noticeable at first, someone smells smoke. A whisper passes through the rows. The illusion begins to tremble. And suddenly, in a rush of fear and urgency, the crowd surges toward the exits all at once. This vivid image captures the heart of Chapter 6 of Manias, Panics, and Crashes, what Charles Kindleberger calls the critical stage. It's the turning point in the life cycle of a financial crisis, the moment when belief falters and the bubble, swollen with excess and irrational optimism, begins to burst. In this chapter, Kindleberger guides us through the mechanics of collapse, not just in financial terms but in psychological ones. The mood turns. The spell breaks. What was once euphoria gives way to uncertainty, then fear, then full-blown panic. Crucially, Kindleberger emphasizes that it's not just falling prices that define this stage. It's the collapse of belief. Confidence, once so abundant, vanishes. Investors begin asking the questions they avoided during the boom. Is this asset really worth that much? Can these companies actually deliver? Is the money even there? And when the answers come, too often disappointing, evasive, or outright alarming, the spiral begins. What follows is a rapid, self-reinforcing descent. Manias, Kindleberger explains, generate imbalances. These may take the form of inflated asset prices, unsustainable levels of leverage, trade deficits, or overgrowth in a particular sector. During the boom, these distortions are ignored or rationalized away. The focus remains fixated on the upside. But once sentiment shifts, those same imbalances become glaring vulnerabilities. A shock that might once have been brushed off, a missed earnings report, a bank failure, a change in interest rates, now lands like a hammer blow. These aren't the direct causes of collapse. They're triggers, exposing just how fragile the structure has become. In this atmosphere of rising doubt, liquidity becomes everything. Investors scramble to sell. But in a cruel twist, as more people look to offload assets, buyers become scarce. Prices don't fall because the assets are worthless. They fall because trust has evaporated. No one wants to be the last one holding the bag. Kindleberger highlights the cruel irony. The rush to safety destabilizes the entire market. At the center of this maelstrom is the banking system, the economy's circulatory system. During the boom, banks often overextend themselves, lending freely to speculative ventures and risky borrowers. But now, as asset prices plummet and borrowers default, banks face a dire scenario. Their assets are losing value, their customers can't repay loans, and their depositors, spooked by headlines, want their money back. What begins as a liquidity crisis quickly transforms into a solvency crisis. Even institutions that were sound on paper now face collapse, not because they were inherently weak, but because they can't meet their short-term obligations. Fear spreads from one bank to the next. Even healthy firms get caught in the panic. The entire financial system begins to seize up. This is where Kindleberger introduces the feedback loop of fear. In an attempt to protect themselves, people pull deposits, sell holdings, and call in loans, all of which only deepen the downturn. Panic becomes a self-fulfilling prophecy, and it doesn't stay contained. The crisis spills over from one institution to another, one market to another. What begins as a localized tremor becomes a global shock. Kindleberger describes panic not just as contagious, but as a kind of economic wildfire, leaping across borders, fueled by uncertainty and mistrust. In the midst of all this, prices lose their meaning. Fundamentals don't matter. Rational analysis is tossed aside. Markets become chaotic. Trading volumes spike. Safe assets become scarce. All that matters is getting out, no matter the cost. Kindleberger also turns his attention to the role of the media during this stage. Just as the press can amplify optimism during a boom, it can magnify fear in a crisis. Sensational headlines, viral rumors, and non-stop commentary feed the emotional frenzy. Every development is seen through a lens of doom. Confidence, once intoxicating, now gives way to paralysis and suspicion. Yet Kindleberger's diagnosis is not about casting blame. He doesn't wag a finger at individual investors or specific institutions. Instead, he sees this critical stage as an inevitable phase in the boom-bust cycle. The same crowd psychology that fuels optimism now fuels dread. The same networks that once spread euphoria now carry doubt and despair. Panic doesn't emerge from nowhere, it follows a pattern. Slowly at first, then all at once. And perhaps most importantly, Kindleberger wants readers to understand that the real tragedy of crises isn't the crash itself. It's our failure to anticipate it. The warning signs are often there, but ignored. The questions are known but postponed. The risk is understood but dismissed. Until, inevitably, the system tips and the theater fills with smoke. Chapter 7: Domestic Contagion. It begins like a whisper in a quiet room, barely noticeable at first. One person coughs, then another. Within moments, the whole crowd is uneasy, shifting, reacting. Panic spreads just like that, quietly then uncontrollably. In Chapter 7 of Manias, Panics, and Crashes, Charles Kindleberger explores this phenomenon at the national level. He calls it domestic contagion, the stage of a financial crisis when panic spreads across institutions, sectors, and regions within a single country, transforming what could have been a localized disturbance into a nationwide collapse. Kindleberger doesn't use contagion as a loose metaphor. He means it in a structural, mechanical sense. In a tightly interconnected economy, a crisis rarely stays confined to its origin. A failure in one part of the system can ripple outward, infecting other parts. Not always through direct exposure, but through fear, suspicion, and loss of trust. In this way, financial panic functions much like a virus. Once released, it doesn't discriminate. It moves along paths of vulnerability, perception, and proximity. The chapter begins by laying out a sobering truth. Most financial institutions are not isolated entities. They're part of intricate, overlapping networks, connected by loans, credit lines, derivatives contracts, and customer interactions. When one institution stumbles, the tremors are felt across the system. Kindleberger likens it to a domino effect. Take, for instance, a mid-sized bank deeply invested in real estate. When the housing market crashes, the value of its loan book plummets. In response, the bank tightens credit, tries to recover losses, and inadvertently spooks its own customers. Depositors start to withdraw. Other banks notice and grow defensive. A problem that started in one institution has now become everyone's concern. But contagion doesn't just travel from bank to bank. It jumps across sectors and institutional types. Kindleberger details how stress can spread from traditional banks to non-bank financial firms, hedge funds, insurance companies, mutual funds, and then leak into the real economy. Even strong, well-managed firms can find themselves dragged down, not because of poor decisions, but because of proximity to the crisis or erosion of confidence. In times of panic, guilt is assigned by association. He draws from history to illustrate the point. During the Great Depression, Small bank failures in America's Midwest gradually evolved into nationwide bank runs. More recently, in 2008, the collapse of Lehman Brothers froze global money markets, creating a liquidity crunch that pressured institutions far removed from the original housing collapse. Kindleberger uses these examples to show that in an interconnected financial system, no entity is truly insulated. Fear travels faster than fundamentals. At the core of domestic contagion is the breakdown of trust. Once people stop believing that others are solvent, or that others will keep believing, it becomes nearly impossible to maintain orderly markets. Lending halts. Investment stalls. Even fundamentally sound businesses may find themselves unable to raise cash. Kindleberger highlights how this breakdown is fueled by herding behavior. When one firm starts hoarding liquidity, others follow. When depositors hear whispers about a bank's instability, they rush to withdraw, whether the rumor is true or not. The logic is brutal. Better to be early and wrong than late and wiped out. Another layer of contagion Kindleberger explores is across financial instruments. Panic in one type of asset, say mortgage-backed securities, can trigger a sell-off in seemingly unrelated products, like other asset-backed securities, or even blue-chip stocks. Investors facing uncertainty and illiquidity don't just retreat from risky assets, they retreat from everything. The danger isn't necessarily that these instruments are worthless. It's that no one wants to be caught holding them if liquidity vanishes. For governments and central banks, this stage of a crisis presents an agonizing dilemma. Move too slowly, and the panic spreads unchecked. Move too quickly, and there's a risk of bailing out reckless behavior, creating moral hazard. Kindleberger stresses the importance of swift but targeted intervention, addressing real vulnerabilities without sending a message that failure has no consequences. But there's no easy formula. Some signs of contagion are genuine corrections, not irrational fear. The challenge is that in real time it's almost impossible to know which is which. In the end, Kindleberger reminds us that contagion is not just about one institution failing, it's about what that failure reveals. It exposes the weak links in the system, the dependencies no one thought much about during the boom. A strong system might absorb the shock. A weak one falls apart. And when the system is fragile, fear does the rest. By the close of Chapter 7, Kindleberger has made it clear. We are no longer witnessing an isolated event. We are watching a full-blown unraveling from within. The structure of the financial system, and the psychology that supports it, begins to disintegrate. Emotions override logic. Rumors overtake data. What began as a cough has become a contagion. And in that fevered atmosphere, the collapse accelerates, spreading panic faster than any virus ever could. Chapter 8. International Contagion. If panic spreads like wildfire within a single country, imagine what happens when that fire jumps borders. When fear doesn't just ripple between banks and sectors, but races from nation to nation, turning a localized crisis into a global inferno. In Chapter 8 of Manias, Panics, and Crashes, Charles Kindleberger expands the scope of his analysis to address international contagion, the phenomenon by which financial crises cascade across countries, transforming regional shocks into worldwide disasters. The message at the heart of this chapter is sobering. In an interconnected world, no economy is an island. Capital moves freely. Investor sentiment flows even faster. And financial systems across borders are so tightly linked that trouble in one country rarely stays put. Kindleberger emphasizes that global crises are not always driven by local fundamentals, but by what investors fear might happen elsewhere. In times of panic, perception becomes as powerful as reality. He begins by charting how modern finance has erased geographic boundaries. A headline in Tokyo can trigger a market response in London before breakfast. An interest rate hike in the US can send ripples through bond markets in Brazil. Information is instant and capital is even quicker. This interconnectedness brings many benefits in times of stability, but during crises, it becomes a major vulnerability. Kindleberger highlights that when a major economy stumbles, investors often respond by fleeing risk globally, not just in the country where the problem began. This reaction isn't necessarily tied to the conditions on the ground in other markets. Rather, it reflects a collapse in global risk appetite. As fear takes hold, capital flows out of emerging markets, currencies fall, investment projects stall, and economies that once appeared stable are thrown into chaos. A contagion set in motion not by domestic weakness, but by external panic. This pattern has played out time and again in recent history. Kindleberger points to the Asian financial crisis of 1997, where currency devaluations in Thailand spread to Indonesia, South Korea, and beyond. He references the Russian default of 1998, which rattled global markets and forced hedge funds like long-term capital management to the brink. And of course, he cites the 2008 global financial crisis, which began in the U.S. housing market but swiftly engulfed the global economy. In each case, a seemingly contained problem became a global contagion. One of the clearest mechanisms for this spread is what economists call the flight to quality. When uncertainty surges, investors abandon anything seen as risky, foreign bonds, emerging market equities, unconventional financial products, and rush into perceived safe havens like U.S. treasuries, gold, or cash. This flight may be rational on an individual level, but its collective effect is devastating. For countries dependent on foreign capital, the outflows are crippling. Currencies collapse. Interest rates skyrocket. Credit dries up. Not because these economies did anything wrong, but because global investors got scared. Kindleberger also examines the role of international banks in spreading contagion. Large financial institutions don't operate in just one market. They span continents. Losses in one region force banks to pull back in others. A bank run in Argentina can lead to a credit crunch in Southeast Asia. And if confidence falters in one banking hub, fear spreads to the rest. Trust once lost is hard to contain. As Kindleberger puts it, confidence is portable and so is fear. But fear doesn't just spread through markets, it spreads through policy responses too. Kindleberger stresses how national governments, each acting in their own interest, can inadvertently amplify global problems. One country might raise interest rates to defend its currency, triggering a capital crunch elsewhere. Another might devalue to boost exports, igniting retaliatory measures. A central bank might tighten credit to curb inflation, only to accelerate a downturn abroad. In these moments, lack of coordination becomes a contagion accelerant. What Kindleberger argues for, urgently and repeatedly, is the need for international leadership and cooperation. In a global crisis, unilateral actions are rarely enough. What's needed is a lender of last resort on a global scale. An institution or authority capable of restoring confidence across borders, injecting liquidity, and stabilizing the broader system. He acknowledges that this is no simple task. Global cooperation is politically difficult, messy, and often delayed. But without it, countries are left to fend for themselves, and the result is often a race to the bottom, a cycle of competitive self-preservation that only deepens the pain. Historically, this leadership role has fallen at different times to different entities: the Bank of England in the 19th century, the United States in the 20th, or the International Monetary Fund (IMF), in various modern crises. But the responsibility is never automatic, and the will to act in the global interest is not always present. Kindleberger's point is clear. When everyone waits for someone else to lead, no one leads and the crisis worsens. By the end of Chapter 8, Kindleberger has widened our view from the individual investor to the entire globe. He has shown us how fear travels across borders with startling speed, how financial instability in one nation can ignite volatility in dozens of others, regardless of their own fundamentals. He reminds us that in today's world, the pain of one becomes the risk of all. And unless someone is willing to act, not just quickly but globally, the fire doesn't stop at the border. Chapter 9: Bubble Contagion. Tokyo to Bangkok to New York. What if the mania doesn't erupt in just one place, but ignites in several, feeding on itself across borders like wildfires leaping treetops in a windstorm? In Chapter 9 of Manias, Panics, and Crashes, Charles Kindleberger explores this alarming possibility: bubble contagion. Unlike the panic-driven international contagion discussed in the previous chapter, this is about how speculative booms themselves spread, how euphoria travels, multiplies, and creates synchronized bubbles that stretch global systems to their breaking point. We often imagine manias as isolated, contained within the borders of a single country or asset class. But Kindleberger insists otherwise. Bubbles travel. They migrate, driven by psychology, by liquidity, and by global capital in search of the next big win. Euphoria doesn't need a passport, follows patterns, not places, and as it moves, It amplifies instability across financial systems that are more interconnected than ever. Kindleberger grounds his argument in a series of real-world case studies that span just over a decade, but cover the globe. He begins with the Japanese asset bubble of the late 1980s, where real estate and stock markets soared to irrational heights. That was followed by the Asian Tigers boom in the early 1990s, driven by explosive growth and heavy investment inflows. Soon after came the Thai baht crisis in 1997, which triggered a broader meltdown across East Asia. Then, barely a year later, Russia defaulted on its sovereign debt, shaking global investor confidence. And by the end of the decade, both Silicon Valley and European tech markets were caught in the grip of a speculative frenzy, culminating in the dot-com collapse. Each bubble had its own local flavor, its own triggers, policies, and market structures. But Kindleberger shows that they also shared strikingly similar external catalysts: loose credit, international enthusiasm, and a widespread willingness to believe that growth had no ceiling. At the core of bubble contagion is the geography of speculation. Investors don't operate in isolation. When they see profits in one market, they look for the next. Capital is opportunistic and migratory. It doesn't linger, it follows returns. And as it moves, it inflates new bubbles elsewhere. A mania in Tokyo can inspire a boom in Bangkok. The success of emerging markets in Southeast Asia draws attention to Brazil. A rally in Silicon Valley fuels optimism in Frankfurt. It's a chain reaction of optimism. What makes this dynamic particularly dangerous is the feedback loop between markets. Kindleberger offers a compelling analogy. Just as one infected traveler in an airport terminal can trigger a global outbreak, so too can a bubble in one country spark mirror bubbles elsewhere. It's not just about money flowing across borders. It's about confidence, stories, and expectations moving even faster. Bubbles abroad validate bubbles at home. Domestic investors see international rallies as proof they're not being reckless. Foreign manias seem to justify domestic excess. It's a mutual validation machine, powered by a global echo chamber. Global financial institutions play a crucial role in this transmission process. Large banks, hedge funds, and investment firms don't just operate in multiple markets, they link them. When one position succeeds, they deploy more capital elsewhere. When one position fails, they're forced to liquidate others, even if those assets are fundamentally sound. This is how a real estate correction in Bangkok can lead to a market sell-off in New York, not because the assets are connected by value, but because they're connected by ownership. Leverage turns localized losses into global disruptions. And beneath all of this is a familiar theme. Human nature doesn't respect borders. Kindleberger returns to a core belief running through his work, that financial euphoria is universal. Greed, denial, envy, fear. These are not national traits. They're human traits. Whether it's Jakarta, Johannesburg, London, or Los Angeles, the emotional patterns remain the same. Everyone wants to believe that someone else is getting rich. Everyone wants a piece of the boom. And so the playbook repeats, just on a bigger, more synchronized scale. What sets bubble contagion apart from ordinary manias is its amplifying effect. When multiple regions are overheating at the same time, the global financial system faces three compounding pressures. 1. Capital becomes dangerously overextended. 2. Risk is mispriced everywhere. 3. Policymakers are pulled in opposite directions. And when the bubbles burst, they don't burst in isolation, they burst together. This leads to simultaneous deleveraging, synchronized recessions, and cascading trade shocks. The pain doesn't just ripple, it collides. Kindleberger warns that correlated bubbles are among the most difficult crises to contain. Their complexity requires international coordination, robust institutional buffers, and, most importantly, a recognition that speculative excesses are often global in nature, even if they appear local at first. Without that recognition, authorities risk treating symptoms while ignoring the system-wide infection. By the end of Chapter 9, the conclusion is unmistakable. In a world of hyperconnected finance and shared narratives, manias don't stay put. They migrate, they reinforce one another, and they grow stronger as they leap from one market to the next. A local boom can become a global problem, not just through panic, but through euphoria itself. In Kindleberger's view, this is one of the most dangerous forms of contagion, not the fire that spreads after the bubble bursts, but the one that spreads while it's still burning bright. Chapter 10. Policy Responses, Letting It Burn Out. Imagine a wildfire raging across a dry forest. Flames tear through the trees, consuming everything in their path. Do you send in the firefighters immediately, dousing the flames before they reach the town? Or do you let the fire burn itself out, allowing it to clear the deadwood and fertilize the soil, painful as the process may be? In Chapter 10 of Manias, Panics, and Crashes, Charles Kindleberger applies this metaphor to financial crises. The question at the center of this chapter is deceptively simple. Should governments and central banks intervene in a financial panic, or should they let the crisis run its natural course? The implications of the answer, however, are anything but simple. Kindleberger explores the tension between two opposing impulses, rescue and restraint, and how each can shape the future of an economy for years to come. On one side of the debate is the argument for letting it burn. This view, favored by classical economists and free market purists, holds that intervention distorts natural market forces. Crises, in their eyes, are necessary correctives. Bubbles form because of reckless speculation. If policymakers intervene to cushion the fall, they risk creating moral hazard, a situation in which investors are shielded from the consequences of their risk-taking and are therefore more likely to take even greater risks in the future. Let the guilty fail, the argument goes. Let markets clear. Let the system purge its excesses. That's capitalism. Kindleberger doesn't dismiss this perspective. In fact, he points to historical examples, such as 19th-century British financial crises, when the government deliberately allowed failing banks to collapse in order to preserve long-term discipline. The message was clear. There will be no lifelines for the irresponsible. But Kindleberger also shows that this approach comes at a steep cost. Markets are not governed solely by logic. In times of panic, fear overtakes reason, and even sound institutions come under attack. Credit markets freeze. Confidence crumbles. The fire doesn't just consume the underbrush, it spreads to healthy trees, burning the entire forest. Left unchecked, panic can produce prolonged recessions, mass unemployment, and a breakdown of trust that takes years to repair. Against this backdrop, Kindleberger makes a compelling case for targeted, timely intervention. He argues that while market discipline is important, the chaos of a panic is not the time to enforce it. Financial systems under siege don't resolve themselves through tidy rational adjustment, they unravel. And in such moments, doing nothing can be more dangerous than doing something. Intervention, he insists, doesn't mean rescuing every failing institution or bailing out bad bets. It means providing liquidity to a paralyzed system, stepping in as a lender of last resort to restore confidence and halt the feedback loop of fear. Here, Kindleberger draws on Walter Bagehot's famous dictum. During a crisis, lend freely, but at a high rate of interest, and only against good collateral. The goal is not to reward speculation, but to prevent systemic collapse. In Kindleberger's view, the key lies in balance. Policymakers must walk a tightrope, intervene too late or too timidly, and allow a manageable crisis to spiral into a catastrophe. Intervene too aggressively or without discipline, and plant the seeds of the next bubble. There is no universal formula, only trade-offs. Timing, credibility, and context matter. He underscores this with a lesson that would become all too real years after his writing. The case of Lehman Brothers in 2008. Initially, the U.S. government chose not to intervene, hoping to enforce market discipline. But the fallout was immediate and devastating, triggering a global panic. Ironically, it was only through swift subsequent action, massive liquidity injections, bank guarantees, and fiscal stimulus, that a complete economic collapse was averted. Though Kindleberger wrote well before this episode, his analysis eerily anticipates the dilemma. Crisis management requires judgment, not ideology. By the end of the chapter, Kindleberger doesn't offer a neat solution, because there isn't one. Every policy choice during a financial panic comes with consequences. But what he insists upon is this: inaction is a decision, and often the worst one. Hoping that markets will correct themselves while the system grinds to a halt is not prudence. It's paralysis. What Kindleberger ultimately calls for is a deeper understanding of both economic systems and human behavior. Crises aren't just about mispriced assets or bad debt. They are about emotion, panic, herd instinct, the collapse of trust. And when the machinery of credit, commerce, and confidence comes to a stop, someone must step in and turn the engine back on. The fire may burn, but someone still needs to rebuild what's left standing. Chapter 11. The Lender of Last Resort. Picture a storm-ravaged harbor. The waves are violent, the ships tossed and broken, the night dark with uncertainty. In the chaos, one light shines steadily from the shore, a beacon offering direction and hope. In the world of finance, that lighthouse is the lender of last resort. In Chapter 11 of Manias, Panics, and Crashes, Charles Kindleberger delivers one of the most essential and nuanced discussions in the entire book. The role of the lender of last resort, OLR, in rescuing financial systems gripped by panic. When markets freeze, when credit disappears, when confidence evaporates like morning mist, there must be an entity powerful and trusted enough to step in and say, "We've got this." That is the function of the LOLR. This isn't a theoretical luxury. It's a practical necessity in the modern financial world. Building on the foundational work of Walter Bagehot, who first articulated the principles of central bank intervention in the 19th century, Kindleberger adapts and expands the concept to meet the complexities of interconnected, globalized markets. At its core, the lender of last resort is usually a central bank or monetary authority with the capacity to provide emergency funding to otherwise healthy institutions facing liquidity shortages during a financial panic. These institutions may be solvent, they may have assets, but they can't convert those assets into cash quickly enough to meet their short-term obligations. In such moments, the problem isn't insolvency, it's trust. And when no one is willing to lend, the entire financial system can seize up. Kindleberger argues that the LOLR must act quickly, decisively, and visibly. Hesitation, he warns, can be fatal. Panic is a self-reinforcing force, and delay only gives fear more time to grow. If investors believe the system is backstopped, they're less likely to run. But if they sense uncertainty or weakness, they rush for the exits and take the system with them. He revisits Bagehot's classic rules for crisis management. Lend freely at a high rate of interest and only against good collateral. This approach ensures that help is extended only to solvent institutions and discourages abuse of the safety net. But Kindleberger, ever the realist, adds nuance. In a full-blown crisis, what qualifies as good collateral may be suddenly illiquid or impossible to value. The LOLR must therefore balance discipline with flexibility, acting with judgment rather than dogma. Kindleberger is particularly scathing in his critique of central banks that fail to act. He views inaction not just as a missed opportunity but as a danger in itself. Historical examples such as the Panic of 1873 or the halting responses of central banks in the early 20th century serve as cautionary tales. When a central bank is silent during a storm, it sends a message of weakness. And in a panic, perceived weakness is enough to trigger collapse. Still, critics of the LOLR concept raise a valid concern: moral hazard. If financial institutions believe they'll be rescued in a crisis, what's to stop them from taking reckless risks during the boom? Why be cautious if someone else will clean up the mess? Kindleberger doesn't ignore this dilemma. He confronts it directly, but he frames it as a trade-off, not a flaw. Would you rather punish recklessness at the risk of unleashing a full-blown depression? Or would you contain today's crisis, knowing it may incentivize some risk in the future? For Kindleberger, pragmatism outweighs idealism. Yes, moral hazard is real, but so is systemic collapse. And while punishment may feel righteous, it often sweeps up the innocent along with the guilty. By the end of the chapter, Kindleberger's philosophy of intervention is unmistakably clear. A lender of last resort is not a theoretical construct. It is a foundational pillar of financial stability. Without it, localized shocks can become global meltdowns. Panic becomes paralysis. And even the most solvent institutions can fall simply because the machinery of credit grinds to a halt. The qualities a LOLR must possess are threefold: credibility, transparency, and speed. The intervention must be clear and trusted. It must arrive quickly before fear becomes irreversible. And it must walk the tightrope between rescue and responsibility, stabilizing the system without erasing the need for accountability. Kindleberger also issues a warning for the global age. The absence of an effective international lender of last resort remains a profound vulnerability in the world's financial architecture. Institutions like the International Monetary Fund can help, but they often lack the authority, scale, or responsiveness of national central banks. In moments of global panic, no one nation can carry the burden alone, yet no single institution has yet filled the gap. Ultimately, Kindleberger's message is simple but powerful. When panic hits, someone must step forward. Someone must provide liquidity, signal stability, and stand tall while others are drowning in doubt. Because without that voice, without that steady light in the harbor, even the strongest financial systems can be lost to the storm. Chapter 12. Conclusion: The lessons of history. What if the past isn't just prologue but prophecy? What if every financial crisis is not only a cautionary tale, but a blueprint, one we keep rediscovering over and over again? In the final chapter of Manias, Panics, and Crashes, Charles Kindleberger steps back from the detailed anatomy of financial disasters and offers a wide panoramic view. Here, in this thoughtful conclusion, he asks two questions that linger beyond the final page. What have we learned from centuries of bubbles and collapses? And more crucially, why do we keep forgetting? Kindleberger returns to one of his central ideas, that while history doesn't repeat, it most certainly rhymes. The instruments and assets may differ: tulip bulbs in the 1630s, railway stocks in the 1840s, tech startups in the 1990s, or subprime mortgages in the 2000s. But the emotional arc, the speculative frenzy, and the structural weaknesses remain remarkably consistent. The players change. The scenery changes. But the script, the story of boom and bust, is stubbornly familiar. So why, Kindleberger asks, do we so rarely learn? His answer is both honest and unsettling. Our memory is short, but our optimism is long. After a crisis, the pain feels unforgettable at first. But time dulls the sting. A new generation of investors emerges, eager to innovate, to take risks, to believe that this time it really is different. The scars fade, the guardrails loosen, and the cycle begins again. The market doesn't just forget, it wants to forget. One of the major takeaways from the book is the hard truth that free markets are not inherently self-correcting in the face of systemic risk. Kindleberger argues forcefully that they require guardrails, not to suppress innovation or growth, but to prevent reckless excess. He calls for smart, adaptive regulation, active oversight, and the presence of a credible lender of last resort to break the panic loop when it inevitably begins. But he also acknowledges a troubling pattern. Regulation rarely holds steady. During long periods of prosperity, political pressure builds to deregulate, to modernize the system, to unleash market forces. And sometimes those changes do represent progress. But often they merely disguise old risks in new packaging, setting the stage for the next crash. Kindleberger cautions against overconfidence in financial innovation. A new instrument is not necessarily a safer one. Complexity can conceal risk as easily as it can distribute it. Perhaps the most profound insight of this final chapter is Kindleberger's belief that economic systems lack immunity when they lose memory. Without collective remembrance through education, public discourse, institutions, and policy, we're doomed to repeat mistakes. He calls for the preservation of economic memory as a civic duty, because forgetting is expensive, and repetition, as history has shown, is brutal. He also encourages humility. No economist, investor, or policymaker can predict every crisis. That's not the goal. Instead, we must learn to recognize the conditions that make bubbles likely. Easy credit, unchecked optimism, herd behavior, and displacement events that suddenly shift the landscape. When these signs appear, the right response is not to rationalize them away but to act with prudence and perspective. In his closing reflections, Kindleberger reminds us of the global nature of modern crises. In an interconnected world, financial disturbances don't stay local. They travel fast, wide, and often unpredictably. Today, a panic in one country can ricochet across continents in hours. That reality demands international cooperation. Institutions like the IMF, the World Bank, and national central banks must not only coordinate responses, but also build shared frameworks for crisis prevention. Leadership matters. So does timing. And so does the courage to intervene early, when it's still possible to soften the blow. But Kindleberger doesn't offer a grand solution because there isn't one. Financial systems are built by people, and people are emotional, ambitious, flawed. There will be future manias. There will be future crashes. Yet rather than resigning us to fatalism, Kindleberger leaves us with something more useful. A lens. A way to read the signals. A way to think clearly in the fog of euphoria or fear. A reminder that the waves will come, but we can learn to read the tide. His final message is not about pessimism, but about preparation. 1. Crises will come again. 2. We will be tempted to forget. 3. But if we remember, really remember, we can soften the blow, shorten the pain, and perhaps avoid the worst of it. Financial disasters, Kindleberger reminds us, are not fated. They are forged through human psychology, policy decisions, and systemic complacency. We may never fully prevent them, but with discipline, memory, and humility, we might weather them with less damage and more wisdom.